Welcome to webinar number 4, the geometry of wealth. Might notice I have some new glasses on. Tyson Strachan, one of the other advisors with our group, mailed these over to me to my house. Apparently, these, I look at computer screens all day. Apparently, these are supposed to block some of those harmful rays. So I don't think they look horrible, but also on the call with us, another advisor, Patrick Gall. Patrick, can you hear me, I hope?
Yep. Sound good, you look better. Clark Kent over here presenting on the geometry of wealth today. Yeah, if anyone has any problems hearing Johann, viewing the webinar, shoot me an email. You can just email to info@oceansideadvisors.com. That one feeds into my inbox. Also, if you want to post questions during the webinar, we're actually not going to wrap up with a Q&A today, but we will get back to you, sometime this afternoon or tomorrow. We just got a busy afternoon, so we're going to try and keep the webinar to 45 minutes, I think, today.
Perfect. Thanks, Patrick. Also want to wish early Father's Day. Happy Father's Day to the dads out there. It's always a fun little weekend. Okay, so the geometry of wealth. Those of you that watch my my Monday little videos I put out, I read this book last weekend. I was kind of wondering what we were going to do our webinar on this week, and I really enjoyed the book. It's Dr. Brian Portnoy. He was in the industry for many years. He's worked for hedge funds, and then he went to the educational side of things, and then back, and now he's an author, and so he just has a great perspective on financial planning, on investing, behavioral psychology, and he wrapped it up into this book, The Geometry of Wealth, that I just really enjoyed, and I thought there was some really nice content. And this webinar is going to be a little bit different than if you watched our previous 3. Okay, so it's going to be a little bit less technical. So I hope you're okay with that. We've been going over some pretty complex matters in the past. So this one's going to be a little bit less technical, a little bit more big picture. And I think some of you will enjoy it. I would encourage you to read the book. Like I thought it was really well laid out. I'm going to be skipping. Of course, we're trying to put this whole webinar in 30 minutes, 45 minutes, but I was skipping full chapters where we're going to go over none of the content from certain chapters. So if you kind of enjoy the general idea of what we go over today, I'd encourage you to get the book. I think it's a good read. Okay, so let's, again, like Patrick said, feel free to type in a question. Although we're probably not going to go over it today, but we'll get back to you as soon as we can. All right, quick disclaimer that we always put at the beginning of our webinars. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Now, like I always say, we would be happy to give you this advice. We do every day. We just need to get to know you and your personal situation a little bit better before we can offer fiduciary advice on these topics. Okay, so the geometry of wealth. These are the 4 main points that we're going to go over today. First of all, Dr. Portnoy lays out, I like how he distinguishes the concept of being rich from wealthy. And you will see what I mean by that in just a moment here. And then the three shapes, and hence, geometry, purpose, priorities, and tactics are what we're going to be going over here in the next half hour. Okay, so starting off, let's distinguish the way Dr. Portnoy splits up rich from being wealthy. Okay, so he defines, rich as having, quote unquote, more. All right, it's this push for more that is many times a treadmill on which satisfaction is typically fleeting. Okay, and we see this a lot from people. I think society today in general. This quest to be rich usually doesn't end where many of its sojourners think it will. All right, so it's when you look at this concept of rich, many times it's just this fleeting satisfaction. In contrast to that, Dr. Portnoy lays out this alternative of being truly wealthy. All right, and a term that we'll use a few times today. It's this idea of funded contentment. Okay, and this funded contentment is the ability to underwrite a meaningful life. All right, however one chooses to define that. So that's likely going to be different for everyone. And this funded contentment, that this true wealth is only achievable in the context of a life in which purpose and practice are thoughtfully calibrated. All right, so I really like this, and I just, in practice we see this a lot. It's so true. Like, purpose and practice have to be thoughtfully calibrated. We'll have people many times come to our office for the first time, and they'll have a great sense of meaning, what the areas of their life that they care about the most and the people they love, and they have tremendous purpose, and they have no plan, right? So in practice they have no method of getting there. And conversely, sometimes people will come in and they, on the surface, it looks like they have actually a pretty well thought out financial plan. And then maybe a year or two in, they're kind of missing a sense of happiness. And I think a lot of people, dismiss this purpose piece because, so point being, like in isolation, purpose and practice, it's usually not good enough. Okay, and you really need both of these pieces thought out. Well, I like the word calibrated, but put together in a way for you to achieve this funded contentment and this sense of true wealth. All right, so the geometry of wealth, we're going to break this down. So the way he lays it out, Dr. Portnoy, like it all starts with purpose. Okay, and for purpose he uses a circle. You'll see why in a minute here. And you take that purpose and you build this into priorities, which is represented by this triangle. And from priorities, there you're going to build all the tactical means of achieving this funded contentment. Right. And then he also introduces this this term adaptive simplicity. Okay, and that's kind of how you move through these three shapes, because as we know, like life is unpredictable, right? So this adaptive simplicity, he defines it as the mindset that accepts that change and complexity are unavoidable features of daily life, but then responds by embracing the frequent challenge of rolling with the punches and cutting through the noise. And it was kind of fun. In the book, he quotes he reads a piece of Dr. Seuss's last book that was ever published. I'm sure many of you have read it. Yeah, so 1990, oh, the places you'll go. And so this short little paragraph from that book, it reads, "Wherever you fly, you'll be best of the best. Wherever you go, you will top all the rest. Except when you don't, because sometimes you won't. You get mixed up, of course, as you already know. You get mixed up with many strange birds as you go. So be sure when you step with care and great tact. And remember that life's a great balancing act. Just never forget to be dexterous and deft, and never mix up your right foot with your left." And yeah, I think, although, an elementary book in whatever, just a few hundred words, there's so much truth in that. Like, life changes, it's unpredictable, it's unavoidable, but responding to this change and embracing these challenges, as Dr. Portnoy writes, rolling with the punches, cutting through the noise, and working these purpose, priorities, and tactics, that's the ultimate goal, to live a meaningful life, funded contentment. All right, so we're going to start with this first purpose. So the first shape. So this is a circle. So purpose, this is a part where we intersect happiness and money. Okay, so we define. So you see this is just an ongoing process, right? You define what means most to you in life. And as we just read, life is going to change. We know that with certainty. And then adapting as your life changes, right? You're going to grow, you're going to develop skills, you're going to, have new relationships, right? It's, you might get married, you might have kids, maybe grandkids, and you might lose a grandparent, you might lose a parent, you might lose a spouse. Life's this, never-ending circle, and defining what means most to you and adapting in this ongoing process. This is the part where we're referring to purpose, and this is going to change, from when you're 20 to when you're 85, right? It's this process of defining the purpose, and this is kind of step one. All right, so there's a quote from the famous writer Dostoevsky. The mystery of human existence lies not just staying alive, but in finding something to live for. And Dr. Portnoy, he writes, he describes these four primary enduring sources of a joyful life. And he's looking at things all the way back, 2,500 years ago, like Aristotle, to scripture, to some of the more recent scientific studies that have been done on happiness and a joyful life. And he breaks it down into four things. They all just happen to start with a C. But the first one's context. All right, so context is this need for a purpose outside of oneself, something bigger than you. So for a lot of people, that might be faith, serving, giving, volunteering would fall in this. But just finding some kind of purpose that's bigger than you. The next source of a joyful life is connection. We human beings, we have this need to belong. So whether that's family, our sports teams, right? I know down here in South Carolina, a Clemson fan wouldn't be caught dead at a South Carolina Gamecocks party. Our hobbies, social relationships, we all have this need to belong. So finding people that are like-minded to us in this area can bring a great source of joy in your life. Competence is the third source. So this need to be good at something worthwhile. So meaningful work, mastery of a craft, just having something that you really enjoy and that you can make a difference in the world. Yeah, and this doesn't have to be in your working years. This can be something you're passionate about after you retire, right? So maybe some kind of part-time work in retirement. Just it'll help though if you can work on something that will demand a little bit of competence. And lastly is control. So this is the need to have to have some kind of control on your destiny. And really what he's getting to on this is having proper perspective, building resilience, just being grateful. And an example he points out in this from the book that I really liked. Maybe some of you read the book. So I read this book 3 years ago, the Gulag Archipelago, all right, written by Alexander Solzhenitsyn. I always get his name wrong. Solzhenitsyn, and I'm sure my dad would be able to tell me right away. But so this man was a Soviet Gulag survivor, right? So he was put up in one of the labor camps in northern Siberia, where many passed away. And so he writes this in the Gulag Archipelago. So it's his book after the fact, kind of writing about the whole experience. But he writes, it was only when I lay there rotting in prison straw that I sensed within myself the first stirrings of good. Gradually, it was disclosed to me that the line separating good and evil passes not through states, not between classes, nor between political parties, but right through every human heart and through all human hearts. And that is why I turn back to the years of my imprisonment and say, sometimes to the astonishment of those about me, bless you, prison, for having been in my life. Which is pretty crazy. I think he spent like 10 to 15 years being worked near to death, and yet he looks back on that with he uses it later in his life as actually a positive for that perspective, and to be grateful to now have the freedom to live and the lives that we get to live. So this is purpose, and obviously I'm not a psychologist. I haven't studied happiness, but this plays such an important role in financial planning, because if you don't give this piece of the puzzle meaningful thought, what you come to our office and share with us about what your goals are, and if they're not aligned, then we're not going to build but we're not going to be able to build the financial plan that is going to help you achieve that funded contentment. All right, so the next piece, moving from purpose, like step 2, priorities, right? So priorities is a part where we set these priorities to help make better decisions. All right, so priorities is the triangle that we're going to split up 3 ways. And on the base of the triangle, the kind of the foundation, this is where we want to protect. All right, so think risk first. Many times, these building blocks are, this bottom portion. A lot of times it's kind of the most boring, what we probably think about the least. But it's so important, right? Obviously, none of us think our house is going to burn down, hopefully, but we put that insurance in place anyway, just because the catastrophic loss would be so devastating. From a retirement planning perspective, this is where we take those steps, and we want to make sure that you have enough guaranteed income in retirement. We'll let you know if we think maybe your financial plan's a little bit too dependent on what the market might do. And by the way, a part I left out here, like priorities, like this is where we as a firm really start to get involved. Okay, like this, we try to listen to the purpose and the things that mean most to you, and then we help you try to build these pieces. This is, you know, step 2. All right, and then so match. All right, so, you know, this means keeping your resources in balance. Work for the many different goals. So this is where we're depending what stage of life you're in, right? If you're in the accumulation phase, still working, this is where we're trying to encourage you to, you know, put a certain amount of money in a 401k, put a certain amount of money in, you know, some kind of after-tax account, you know, put some money in a 529 for a grandkid. And this is, you know, we're trying to just help you prioritize that piece. And then the top is to reach. So aspire for more, right? There's nothing wrong with, you know, aspiring to do more things. And he just encourages you to, Dr. Portnoy encourages you to enjoy and just make sure you're being grateful at this top part, because this is where, if you're not careful, you can fall more into that that rich category instead of working for true wealth and funded contentment. Right. Another part of priorities, because it's so important, and if, you know, those of you that watch our Monday videos and have had conversations with me in the past, your behavior needs to be a huge priority. Right, that this quote is so true. And many people are surprised by this, but being market savvy is among the least important sources of wealth, but self-awareness is among the most. Okay, and this difference, right, is so we call this the behavior gap, right, between what, for example, the stock market earns and what the average stock investor earns, right? There's this huge gap. It's like 4 to 5% a year, sadly, and it's 100% attributed to behavioral errors, human errors. All right, so we're just going to touch. I know we talk about these a lot on Monday emails and in the office, but they're so important. And Dr. Portnoy, he puts a whole chapter on this. So I just want to outline some of the big ones. All right, so loss aversion. Okay, losses feel worse than gains feel good. Right, and this affects how we seek or not to take risk. Right, so this can work both ways in a negative way if we don't recognize it. Confirmation bias. So many times we seek out information that substantiates our previously held beliefs, thus inhibiting the ability to learn. All right, so for example, if you might in your mind think Amazon's the best company ever, and it's going to continue to have the highest returns of all stocks forever. And if you go on a Google search and you search, you know, why is Amazon the best stock ever, you'll probably find a bunch of articles that will substantiate that belief. Okay, and confirmation bias, it's a big problem, not just in finances, but you can think of a number of other areas in your life where this could be a problem. Recency bias, we talk about this one a lot, but this is our human brains prioritize events and outcomes that we've most recently faced. All right, so you know, this is especially true for investors that, you know, sign into their accounts daily or even monthly, right? So if you're looking at your account all the time, which I'm not saying that's a bad thing, but it's important, if you do, you recognize this. You might look at a really bad month in the market and totally forget how well things have gone, you know, maybe over the last 2 years or 10 years or over your lifetime. So just keeping that recency bias in mind. Overconfidence bias. So we think we know more than we do, which can lead to unduly bold decisions. Availability bias is huge. So this is, we weigh more heavily readily available information and tend not to seek out that which does not come immediately to mind. So the easiest, probably best example I can think of here is, let's say you want to learn about the stock market, how it works. What do most people do? You turn on your TV, right? Because that's probably the most readily available. You turn on your TV, you turn to the CNBC channel, stock market channel, whatever that might be, maybe Bloomberg. And what you're going to get on there is, I'll tell you right now, is not the best sources of information. Okay, if you really want to learn about the markets the way true wealth is built, you want to understand some truth and complex topics, like you don't turn to CNBC and listen to a bunch of pundits with massive conflicts of interest that are really, it's just an advertising network. It's not true advice. If you really want to learn, don't go to the most read, don't turn your TV on. Instead, you read books like this one, right? So some Geometry of Wealth. This is a great book. I've tried to have I've recommended a lot of you look into reading. This is The Investment Answer by Dan Goldie. You could read The Behavior Gap by Carl Richards. I mean, there are a number of really educational and great books about the best way to invest and long-term financial planning. CNBC is not the best way to do it, I promise you that, but it is the most readily available. So be on the lookout for that availability bias. And then this endowment effect, right? So we tend to value something more that we already own, making it more difficult to sell something that we should, right? Where we see this a lot is somebody works at the same employer for 20, 30 years, and as part of their compensation, they've been given company stock throughout all those years. And without question, like, especially in retirement, like you should be selling the vast majority, if not all of that stock, and diversify, spread out your assets, and have a safer, less volatile portfolio. And many times that's hard for people to do, right? We tend to, if we've owned it for a long time, especially if it's the company that you put your blood, sweat, and tears into, sometimes it's really hard to part ways with the company you've owned for a long time. All right, moving on to the third shape. This is tactics. All right, so this is going to be the square. This is the part where we strive for decent outcomes. All right, so each of the corners of the square, these are the four terms that if you hung out with us in the office, you would hear these words thrown around a lot. So, starting in the top left, moving clockwise: returns, volatility, liquidity, and correlation. And what I really like is what Dr. Portnoy does. He finds just some household, I don't know, I guess you call them synonyms to some extent. Just some words that might make more sense to people that aren't doing this for a living. So really, like when we say returns, really we're talking about growth, right? How much something can grow. When you hear volatility, a lot of times we're talking about pain, like that emotional pain. Liquidity, that's just the flexibility of how easily you can move in and out of a position, or even within your own personal finances, having the flexibility to hold assets. And last is correlation. Is definitely the most technical of all four of these. And here, all correlation really means is fit. So how do the pieces of your portfolio like fit and work together? So that's what we're looking at there. And so kind of starting with growth. So that top left corner, we're just going to touch on these four corners. Expectations are so important. And so Dr. Portnoy, right, understanding what gains are reasonable in the near and distant future is ground zero of expectation setting. And lay out some really nice things here. So if I asked you the question, and if you asked, a friend this question or anyone else, what do stocks typically return in a year? Usually you get, the same, a pretty tight range of answers. So it's usually right around 10%, right? For the stock part of your portfolio. So just the most aggressive part, what do stocks typically return? And 10% gets thrown around. And looking at this, average annualized return by rolling years, like that's actually pretty accurate, right? The average annualized returns, it's right around 10%. Now, I'm just going to define rolling years here. What rolling years means, that what they're doing, they're making the data set larger. And what I mean by that is, if you just took each and every year, like, 1936, 1937, 38, 39, you might have 100 years of worth of data. But what rolling years are, that just means, to increase the data set, you could also look at a year, not by the calendar year, but by, like, start it February 1st and then end it the following January 31st, right? And then you could do another rolling year, like the next one could be, like March 1st going through February 28th, right? So you're increasing the sample size of returns over time. So that's what rolling years mean. But back to the point, like average annualized return, just the average return by rolling years, like 10% is pretty accurate. Okay, now, so if 10% is the average rolling annual return for stocks, like, what about the range of returns, right? Because this is going to be totally different, right? Because the range of, we know that it's not 10% in a straight line, right? So to put this in perspective, so here's the range of, let me get my pen out here. So here's the range of annualized returns by rolling years. Okay, so in other words, if you only have a 1 year time horizon, like you could have anything, again, this is the stock part of your portfolio, you could have anything from down close to 70% to up higher by 170%, right? So that's the potential range of returns if you have a 1 year time horizon. Now, as you can see, if you have a 2 year time horizon, so moving out a year, this range of possible outcomes starts to get tighter, right? So maybe you're, worst case scenario, you're down 50% here. On the upside, maybe you're up 70 or 80% there. But point being, you can see as the years go on, 3 years, 4 years, 5 years, you'll notice this convergence in the range of outcomes, right? Where, well, once you get to this, 6, 7, 8, 9 years, we have a pretty high degree of confidence of the range of potential outcomes. And that's why time horizon is so important when trying to figure out which investment strategy is most appropriate for a certain goal in your life. To put it another way, to go back to just put it in more of a normal distribution. So here, let me get the pen out again. Okay, so here's the distribution of rolling 1 year returns. Okay, so again, just 1 year time periods, rolling returns, right? So a large data set. Obviously, the most common outcome in a 1 year period is you're going to gain between 10 and 20%. Okay, this is a little confusing the way they did this chart, but really these are all plus signs. This is between, for example, a positive 10, between 10 and 20%. So obviously the most likely outcome in any single year is you're gonna have a gain between 10 and 20% on your stocks. Sometimes you're gonna have a smaller gain, but you'll see in any 1 year period, you could have some really bad outcomes out here, right? So you could lose over half your money. you could lose between 40 and 50%, 30 to 40% down. This is not good. So you could have some really bad 1 year time periods. Now, what's really neat, if we take one more step though, much like we kind of saw in the last example, we take one more step. Instead of looking at single years, let's look at 10 years. Now look at this, 10 years. Now we're looking at rolling 10-year periods, right? So instead of 1 year, we're looking at what if you invested the entire time from 1940 to 1950, or from 2010 to 2020, or 2011 to 20, right? So any 10-year periods, rolling 10-year periods, they're a huge data set. And what do you notice? Like, we have no tails anymore, nothing out here, nothing on the high side either, right? But what this gives us is, we know if we have a 10-year period to invest, almost every single outcome, we have a high degree of confidence that in a 10-year period, we're going to earn something between 0 and 20% with a high degree of confidence. Now, there is a small chance, a very small chance, that in a 10-year period, you might lose a little money. But this looks a lot better than, as you saw in the last slide, the chance of losing 50 or 40 or so I just thought this was really neat, and it kind of, we try to preach a lot just on the importance of time horizon. And if you have an investment account that you don't think you're going to need the full balance withdrawn in the next 7 to 10 years, like, you should probably be invested in stocks a little bit. If you have a 20-year time horizon, like, you should probably be invested very aggressively. And that's kind of what we're, hopefully these last 4 slides have pointed out. Okay. All right, so that next corner of the square pane, right? So that's volatility. I like this. He had a lot of good quotes on this, Dr. Portnoy. Volatility, pain, is the emotional cost of achieving the growth that we seek. It's just so true. To transcend the potential pain, one thing that we have going for us is that it's easier to set expectations for volatility than it is for returns. Okay, because looking at history, it's easier to know that, for example, stocks are going to be much more volatile than bonds. Are going to be more volatile than money market. So just and the volatility, it's more inevitable, like he says, and there's a lot of data on this. Like, we know volatility is going to be present. That's a certainty, and it's easier to set those expectations than it is for what returns might be. And so, even though volatility is more predictable, he uses the word jumpiness. That jumpiness encourages bad decisions along the cycle of both greed. So that's things are going well, so now we want to buy more, and fear, right? Selling low, or in other words, some more times than not, a lot of times it means not buying when things are low. This is great. Volatility is the price of admission for access to potential gains. Just really well said. And yeah, just in bold here, successful investing is emotionally painful. I know that, and I've said something similar to that on Monday videos, and that is, like, successful investing, it should oscillate between, when things are going well, it should feel boring. It really should. A lot of times it feels boring, and that kind of goes back to, like, the loss aversion, that behavioral bias, right? Like, when things are going well, like, it should feel boring, right? That's because, again, our human brains, we losses hurt more than gains feel. So when things are going well, a lot of times it'll feel boring, and on the downside, it should feel emotionally painful a little bit. And if it isn't, on those sides, like you might not be invested the best way for you. All right, fit. I'm not going to spend a lot of times on this. Like, there's a whole chapter on this, but I thought it might be too technical. Again, I'm trying to try not to be overly technical. Take a webinar off from confusing everyone. But fit, that just means the correlation. So that's the way that the positions in your portfolio work together, right? And just the bottom line is, I think we've all heard the word diversify before. And what that means, that means spreading your bets, no matter how uncomfortable it feels. That means you want to own large caps and small caps and value and growth. You want to own international. You want to own emerging market. Like, and I guess I'll add one thing on this. Like, even when things are going poorly in one of those buckets, right? Like, a question we get a lot recently is, oh, international has done so poorly over the last decade. Are you sure we want to own it in the portfolio? And the answer to that's yes. And the reason being, if you look back at, say, the 1970s, for example, like, international outperformed the US like 3-1. All right, from the time period 2000 to 2010, international outperformed the US like 2.5 times. And we just don't know when those time periods are going to be. From 2000, the most recent decade, international, it's been a dog. It's been ugly. But absolutely, for somebody trying to work towards, that funded contentment, that long-term wealth, if you want a balanced, diversified portfolio, like, you own those parts, even when those parts of the portfolio aren't doing as well at that time, because in the long run, it pays off. All right, and then flexibility. This is referring to liquidity. Right, so understand liquidity. Be aware of lockup periods, whether or not your investments will be readily marketable. Right, so a lot of times, just be aware, especially in like the alternative investment space, like hedge funds, private equity, some of these private placements, any kind of like real estate investment trusts, especially the ones that, well, almost always the ones that are not publicly traded. You just want to be really careful. And if you're locking up your money for a significant amount of time, it's not always necessarily a bad thing, but just make sure you understand it, understand how long your money is being locked up, and whether or not that makes sense for you and for the strategy that you're implementing, and if it makes sense with your overall financial plan. All right, so kind of in summary, I hope you've enjoyed this less technical webinar, kind of just bigger picture, the geometry of wealth, how our team can kind of help in this process. So for starters, like, tactics right here, this is the area of the process that I believe our firm does really well. Okay, so this is like portfolio management, this is tax planning, this is withdrawal strategies. All right, and the other area right here, like, we also help you set like the priorities. Okay, so when we hear from you, we'll help you try to figure out what we feel is most important, what you need to what things you should be addressing first, and kind of set those priorities. And kind of a big reason why I wanted to do this webinar, like this first part right here, purpose, this is something that this has really got to come from you. You have to reflect, find what's most meaningful to you in your life, and just give it a lot of thought. And in recent years, I've tried to encourage people a little bit more to give this more thought, because if purpose isn't thought out, well enough, and we just kind of blindly go into just a regular traditional financial plan, um, we're probably not going to be able to build that true funded contentment that we're trying to accomplish. And so, we really encourage you to give this purpose a lot of thought. I know it's almost a little awkward for me to bring up because it's, again, I'm not a psychologist. I'm not an expert on happiness, but this purpose piece is it's the first piece. There's a reason it's the first piece in Dr. Portnoy's book, because you figuring out this purpose, what means most for you at this stage of your life, and you being able to communicate with us right here. And this is where we can start putting everything together for you and start making your purpose a reality, and building this life of true wealth and funded contentment. So just at the bottom there, if you don't feel you're there already, like let's our team would love to help you get there and work towards this. And and also, if you're an existing client and life changes, like we've been over, life changes, and if you feel that maybe there's some new things you want to be doing, and maybe we need to reassess the priorities because maybe your purpose is a little different, let us know. That's we want to do that. And ultimately, I think that's why all of us, myself and Patrick and Tyson, that's why we got in the business. Like the best part of our job is helping people, and I've never put it in the words that Dr. Portnoy has done, but I mean, if we can help the people that we serve find this true happiness and wealth of funded contentment, like, I think we've done a good job. So that's what we strive to do. We would love to help you on that journey. And we appreciate you listening to the webinar today. Again, a little different, a little less technical, big picture, but certainly meaningful. And I hope you enjoyed the time, and certainly feel free to reach out to us if you have questions, comments, concerns. We really do enjoy the feedback that comes from you. So appreciate you taking 45 minutes out of your day here. And again, happy Father's Day to all the fathers out there. We will talk to you soon. Thanks.